All right, Loblaws on Toronto Stock Exchange. This is our 10th in a series of 12 for the COVID-19 stock ideas. I just did Metro. Have a look at that video as well. I think Metro is overall better, but Loblaws might turn out to be a better stock just because they're kind of starting to really improve and ramping up that improvement. This is a fascinating one, and I think our model does a great job of helping us understand what's going on. It really follows what you would think. So, just quickly, actually, why we're doing food. I think it's obvious, but just to make sure, there's been a run on food. People are just going to Costco and here in Canada, Loblaws and Metro are grocery stores, and they're sold out constantly, and lineups, and toilet runs on toilet paper, and all this other stuff. So I think it's an obvious investment. And as I said on every single video in the series, do not buy Loblaws or any other one of these just because of the COVID-19. You must only buy it if you think it's good when this goes away. But if it can work in this environment too, that's just a little bit of a bonus. And I kind of hate saying that. I'm thinking like an investor, and it's a bonus that there's COVID-19. It just sounds wrong, but I think you know what I mean in terms of investing. We gotta separate that. You do have an obligation to manage your money as best you can. And I think, owning a grocery store is probably a pretty good idea in any environment, and especially in this environment. Okay, so anyways, without further ado, let's look at Loblaws. And I love this profile not in terms of investing, but in terms of how our model helped us think about it. So back here in 2001 to 2003, 4, somewhere in there, you see the return on capital was around 13-12%. Stock's doing great. And then as soon as that return starts to slide down, you see the stock slide as well. And then it finds its new bottom, earning about a 5% return. And it just can't get out of its own way for several years. 5, 6 is even down as low as 4. The stock did turn a little bit earlier than the returns did in 2013, 2014. And if you look at the same time down here, there's a 15% growth. I believe that would have been the acquisition of Shoppers. Okay, so, and then things started to improve. And that would have been, something, I think we did pick it up. I have to recall or maybe look up some of my old reports. But Shoppers did look great on its own. Put it together with Loblaws, and Loblaws was bound to improve just from owning it without even any synergies or anything. So I think there was a little bit of restructuring because this looks a little unusual that the return, or sorry, the capital growth goes down and pops right back up. And there's also the IFRS accounting rules. There's a lot going on here. I don't think this is real growth. It's not growing that fast right now. But what I do think is real is that the company's improving, and that's the bottom line. Is Loblaws is more profitable than it was before, in combination with Shoppers, which I think is a really good chain as well. I just think it's a good company now. The reason I said it might be better than Metro is because of the improvement. We know when you get an improving company, the stock can really take off, and we're still in that phase of improving, so it could work out better. For the more conservative person, Metro has been more consistent and just steady, and they're both earning about 15% right now, but it looks like Loblaws is trending higher, so maybe it goes higher, and maybe that carries the stock a little bit more. That's a maybe, though. That's not a guarantee. I like both. I think both can coexist in Canada. They seem to be doing it quite well. Let's look at the dividend history, actually. And that's a great dividend chart. As you can see, as I said, they weren't doing so great, so they had to keep that dividend flat for many years. And then they've slowly but surely started to move it up. And you can see their cash flow has been moving up too. That's the bottom chart. The green is the cash flow. The blue is the actual dividend. It's only a 14% payout ratio. Now, mind you, the yield is only like 1.84. So, but that, you know what? I think the yield's going to go higher. Loblaws pretty solid idea there. I think can step into Loblaws here, even in this crisis, well, especially in this crisis. Thanks for watching our investment video. If you want to improve your portfolio returns, simply subscribe. Or if you're an investment advisor or retail investor and you want help with your portfolio more directly, we can help you with a managed account and manage each and every trade for you.